Thank you, everyone, for joining me tonight for AfroEconomics Live. I got a little bit too excited. It started without cataloging this. So I want to make sure that I first acknowledge Ethel Hayes for hanging out with us tonight, a longtime AfroEconomics member, along with Frank Anderson as well. They are into real estate, as well as many other things. But I asked them if they would share with me tonight on whatever they feel like one of the pros and cons and whatever they wish that someone had told them. Because one of the things about life is as you grow as a person, you just become obsessed with the need to make someone else not make the same mistakes you made. So these two kind people are committed to like helping. And this is just a great opportunity for us to exchange. So I appreciate their presence. Someone has made a chat. Oh, thank you, Ms. Cotman. Oh, thank you. They can hear us all. Everybody agrees we are doing well. I want to share a screen because I know that we're going to go past our regular time tonight because I want to address your questions in real estate. Now, my point, Ms. Anderson, for having this is because I believe that we spend too much money on those real estate women seminars. Like we just go to all these different classes and they're charging like $200, $300 and all these different things. And you're buying all these books. And a lot of times we're missing the core of it. They're just talking about the property. But how you build a profitable real estate system, like every other investment, is way, way more than just the selection of it. You know what I'm saying? It's the taxation of it, the income that it generates, what you're seeking as an investor, what your risk tolerance is, what liquidity you need, what type of cash flow you have so that you can maintain all of these things. If you just went to class talking about how to find the right one and looking at a list of foreclosures and think you're doing something. I mean, seriously, don't believe the hype. So I brought out those key things. I want us to talk about and put these things in your mind. You need to understand when you're in real estate, you need to understand depreciation. You need to understand income. You need to understand capital gains. You need to understand 1031. You need to understand a whole bunch of stuff that we're going to talk about. How your real estate income and what expenses and how to make sure that you include those things in your tax return and stop being afraid of doing it the right way. So many people say, oh, well, I have a property, but I don't put it on my taxes, or I put it on my taxes, but I don't count all my expenses. And then I tell them, well, you're going to be mad because when you sell it, you're going to pay capital gains like an investment. You putting that on your return and you're not reporting your expenses, you're setting yourself up for a lot of disappointment. So let's make sure whatsoever we do correctly and maximize what you are supposed to maximize in order to make it work best for you and your family. So I want to start with sharing the screen on, and this is a title, read it at your pleasure, out of Bloomberg Opinion, online, Bloomberg.com. This is from June last year. Black poverty is rooted in real estate exploitation. And it does research on home ownership in the Chicago area, but it also brings out, most importantly, that during the time period of this, researchers have found that their predatory practices have cost our community billions over the decades. And look at this. So using the data on sales and mortgage rates, they calculated how much each family's payments exceeded what they would have been if the property had been purchased at the prevailing market value with a conventional loan. This article talks about government loan exploitation. They then added it up for all the contract properties that they could identify from the years 1950 to 1970 within most of our lifetimes. The outcome, Black families were overcharged somewhere between $3.2 billion to $4 billion in 2019 dollars. The real estate agents and investors who profited were almost exclusively white. So this represents a direct transfer of wealth from one race to the other. Even worse, it says, the contracts, exorbitant terms, along with the lack of equity to borrow against, because they left Black families, let me pull this up, without the means to invest in their properties, contributing to physical decline of their neighborhoods. This is real. This is real now. There was the FHA scandal, and then the predation ended in the 1960s. It evolved. There was the FHA scandal of the 1970s, in which indiscriminate federal lending and outright corruption enabled speculators to sell inner city homes to Blacks at inflated prices, resulting in widespread foreclosures. Look, come on up. Then there was the subprime boom of the 2000s, in which Blacks were steered into inappropriately expensive loans that enriched the whole ecosystem of mortgage industry professionals, but left borrowers with nothing but an eviction notice and bad credit history. This is in the 2000s, and this is real. And I write about that in my book. So this is why we have to get a better understanding. You're talking about over this all the way up into now, and we still don't understand how we're being taken advantage of when we don't have knowledge. We have to make a commitment to getting a better understanding of things and not just doing things because it's popular. We're just out there buying houses with no money down just because it's a government program that you can put $500 in and get it, and then you're paying all these extra interest rates because your likelihood of foreclosure is so much higher because you have not invested anything in it. And I've had multiple clients tell me what has helped them is the fact that they were forced to. We're talking about they were forced to back in the day, even on an overpriced property, they were forced to put 20% down. So if you were forced to already put down, like even on residents, they didn't want to loan money to us at all. So if you're forced to do that, then you already have some equity in it. But we feel like they're doing us a favor by allowing us to buy homes with no money in savings, no money set aside. And one time, it was back in like 2007, 2008 or whatever, I was like, really like, I want to do homeowners classes. And I signed up, for the government to do these little classes and everything. And I said, well, what you're teaching them is wrong. Like, these people have some savings. And they were like, no, just stick to the script. This is why I said, well, you don't need a financial advisor to do these. These should be whatever these people that you have that are doing this, because any valid financial advisor should be telling the truth. That is ridiculous. And I was like, I can't do these things. You don't want to call me, because almost everybody in the room is not ready to purchase a home. So some key things that I want you to write down is that you need to understand before you buy anything that involves signing your name on it. You need to understand what debt is and how debt can impact you. And I don't care how many people tell you that you are able to get this property with absolutely no money down, that the likelihood of that is I have never seen it before. With no money, well, I'm saying real estate, from a real estate investment perspective. because an investment property is seen totally different than the house you live in. So they'll let you get your primary residence with very little down because you're not going to have anywhere else to live. So they're thinking, so well, certainly they'll pay this loan because this is where they live. But on a rental property or something else, you know, you have to really think about it. I mean, I have seen people use hard money to purchase real estate investment properties, and the property does not grow over this 90 days because they promised themselves that I'm gonna use this hard money lender, and then over that 90 days it's gonna be, I'm gonna get it, I'm gonna fix it up, and it's gonna be worth so much more, and then it doesn't happen. It doesn't happen. So, Mr. Anderson, before I go into some of the depreciation and things like that, could you just tell me that how you feel, what would you say is a key thing when you first decided, I want to look at real estate as an investment? Like, what did you have to, like, what was the key thing that helped you be successful at it? You might not see yourself as successful, but you've had properties a long time and you still have the ones that you want. That is successful to me.
Yeah, well, I started this about 40 years ago, but I didn't really think about it as far as getting into real estate. I lived in New York at the time. I bought my first house in Queens, and then my job, and I stayed there for a few years. And then my job I transferred jobs to another location, which was out in Long Island. The commute was too much, so I decided to rent my house out in Queens and buy another house in Long Island. So I did that and stayed there for years and was collecting rent, and the rent was enough to pay all of the expenses for the other house. So I learned that, hey, this is kind of cool. You know, I got another property and it's being paid off. Then when I moved to Virginia, I sold the house that I was living in, but I kept the one that was in Queens, and I moved to Virginia, and I bought a house here in Virginia. And then I understood that, hey, you could buy houses and make some money off of it. So then I learned, well, my father was kind of skillful, my brother was kind of handy, and I learned to be kind of handy. So I started buying raggedy houses, which you mentioned earlier, but I bought rundown houses that were maybe foreclosed on, was empty, abandoned, and I fixed them up. Me and a couple other, I got a couple other people to help me out, and I fixed them up and flipped. And that's when flipping was going on. And I flipped a few houses. Then the flipping era kind of died down, and I bought some, and I couldn't flip them anymore, so I started renting them out. And but I mean, I got a few, and I sold a few.
Like, I think that I don't know. Who you think? I don't know why that's doing that. And if you try to mute Miss, and I'm gonna see. Yeah, no, yeah, I think that is. No, that's not it. So it's somewhere I'm getting, like, I don't know. I might not. But we're getting feedback. But we're gonna talk through this, y'all. But how did you get through, like, when you got to that point where it was like, oh, I can't flip anymore? I think was it because you didn't have a lot of debt that you were able to just keep it, like, because and just collect rent? Or was it because you had alternative income, like you had a job, and you were doing it? Like,
all the time I was doing this, I had a job. I mean, this was just something I was doing on the side.
Do you think that helped?
Oh, definitely, because my career, I mean, I had a pretty decent paying job, and I didn't need, my job paid for all of my lively expenses. So the real estate was just something I was doing on the side. I wasn't living off of it. I didn't need to live off it. I didn't need to use the money that I was collecting for rent to pay bills or anything. That money was just used to buy more properties or maintain those properties or hire people to fix things on those properties. I didn't have to use that money to live off of. So that was a great advantage for me.
The Dr. Williams, do you act as your own? Miss Dr. Williams was asking if you were a real estate agent, and you're not. You do
No.
everything on your own. Yeah,
Right.
and I think don't you think that helps? That you didn't have to pay commissions like that, like
it worked for me, but if you got, I mean, I was handling maybe 4 or 5 properties at one time. Now I've sold some off. Now I only have a couple now because I'm retired and I don't want to do anything anymore. But if you know how to maintain the properties, I mean, I picked up skills in plumbing, electrical, I mean, I could do a lot of things myself. So I didn't have to hire a maintenance crew. I didn't have to hire people to maintain my properties. But if you are not handy, then it's best for you to get a property manager. It's best for you to get somebody who could take care of your properties. But fortunately for me, I'm pretty handy.
And yeah, I think it does make a difference. And I was saying the other day about people who buy their own business, but they don't, I mean, they start a business, but they don't do it. Like someone who buys a hair salon, but they don't do hair. Like, it's like, if you can't do this, if you're not willing to do it, then it can, but what would you say about that, Ms. Hayes? Are you a handy person? Do you do your own maintenance, or did your husband do the maintenance, or how does it work?
Yes, for the most part, just like Mr. Anderson stated, you have to have some skills to be able to quickly remedy issues that come up. In addition, we have a homeowner's warranty, but at the same time, you know, you still, you don't, if you don't have to call and, you know, and have to pay a copay for that, you know, you can get some things fixed yourself. But yes, my husband and I, we are pretty handy, and we actually did a lot of the remodeling and whatnot to our property. Yeah.
Yeah, exactly. I feel like you do have to, I think that you have to have a certain amount of maintenance. That's why I always, tell people that you have to be all in. Like, they kind of think like but you can do real estate, of course. You can do real estate through stocks. I can put you in stock, real estate investment trusts and all of those things. But you also, I think that, how do you feel about the liquidity factor of having the properties? Like, Mr. Anderson, have you ever wanted your money back and the property wouldn't sell as fast as you wanted to?
Well, that's why that period, I don't know when that was, in the 80s or whatever, when there was a period of time when you couldn't, it was very hard to sell a house. So that's when I went to renting them, because I couldn't, flip them. I couldn't flip them. So then I started renting them out. Exactly. That's why I did that. Because right. I just wanted to flip houses.
That's right. And do you believe in, like, did you tie yourself, this is, someone was asking, like, did you work closely with a banker, or did you focus on using your own money? And both of you can kind of, did you focus on trying to finance everything, or did you try to take money from one and use it for another, or did you always have to get a bank involved?
I always got a bank involved. I mean, at this point, I have mortgages that are paid off, so.
Yeah, but at the beginning, when you
had. At the beginning, yeah, I went to the bank.
And then I also noticed, like, in the beginning, like when they say that, you can do this with, like, you don't have to have the mortgage involved and things like that. I think that that's kind of misleading, because I do feel like it's a lot easier for someone to do this that has a job, or has equity in their first property, or has, some sort of leverage, some sort of collateral. when you start going into an investment level. I feel like, and I know that you all see, like, some of the commercials that you see are kind of misleading. You know what I mean? For the majority of people, like when I talk to people who want to start a business and they feel like there's a loan out there for startups, you know, like there's like this loan, like they feel like, you know, that there's something out there for them. But just as with real estate, even a lender wants collateral. They want to be attached to your money. They're like, okay, Ms. Hayes, I'll do this, improvement on this investment property, and so you can flip it. But you know what I mean? We want you on it. It doesn't matter what they name it. Would you agree? Like, you can name it XYZ Properties. They still want your personal guarantee that they're going to get their money back.
That is true, and they want it quickly.
Yeah.
If you're trying to flip a house, they want you to turn that money around pretty quickly. And we've never flipped a house. We still have our house. We've had it for over 30 years. It was our first home, so it was a default that we ended up just saying, okay, let's buy another house.
That's
and
right.
Use that house as rental and let it be income to pay for, college or retirement.
That's right. That's right.
But I wish that, in hindsight, I do wish that Rob and I would have had some good advice like what you offer now, JB, because we would have probably paid the property off. We've had it long enough to have paid it off, and so it's not paid off. And we, unlike you, Mr. Anderson, we needed the money to pay the mortgage. Even though we are full-time and we are employed, we still wanted that money wanted the money from the rental property to cover the mortgage for that house, and we did.
And Mr. Anderson was saying that that's where he started too. It just elevated, as over time. We're talking about 40 years, that it's, if you do the right thing. One lady says here, she says, like, the no money down mindset is misleading. It really is. Like, we have to, and then the question was, did you ever consider investing in commercial properties? Yes, I have. Mr. Anderson has as well. Like, wouldn't the apartment building be considered commercial? Not really?
Well, that's the only one. But all the other single family houses would not, they're just single family houses, and I just renovate.
Or maybe they would consider, what do y'all call that? Like multi-unit instead of commercial, where mine truly was commercial property. Yes. And but I found that for commercial property, I started researching so much that it wasn't cost effective for me to have that much money into the commercial property anymore. And because I planned the sell of it, it worked out for me. But if I had listened to everyone else, I would not have sold it. They kept saying, don't sell that. You can do this and you can do that. But I know what I do for a living. And when you do real estate, you have to be in it for real estate. And I did not have any time to be anybody's landlord. You know what I mean? And things like that. It was like, if this commercial property can't produce for me. So I used to live up top and use my office on the bottom. And I grew out of that experience. And I said, it's time to plan to move, to sell, because this isn't working for my long-term goal going forward. But so what you have to think about is, you can see between these situations that I lived here, then I moved over here, then I did this, and he got better and better at it, and he had an understanding. Dr. Williams says, for novice real estate investors, what are the best ways to identify properties to buy? REO lists, tax delinquent properties, estate sales. I would say all of that, right?
I would say don't do it by yourself. Go in with someone who can look at the property and tell you what may need to be done to the property. I don't know if
Oh,
Mr.
you're saying like even if it was on a foreclosure list, if it was on the list,
Yep,
don't like, I mean, get
assume.
like hire somebody real estate owned. That's right. Oh, and the RE always said it's real estate owned list. But that
Don't
hire
assume.
somebody like kind
Yeah,
of like if you were gonna buy a used car, right? You would want to take it to a mechanic, to make sure like,
yep.
you want to make sure you have the house or the property inspected.
I
And
just say, yeah, don't assume that it's turnkey and that you can go in and say, oh, I can do some decorating and cover this and cover that.
yeah.
Because
And I feel like that's the mistake I made on my commercial property. It
mhm,
was like 6,500 square feet, and everything, Mr. Anderson, was on the roof, and I didn't get that. I had no idea what that meant. You know what I'm saying? Like everything was on the roof. So then after I owned it, then all of a sudden, like the lady that it was through an estate sale, the lady who sold it to me, she said, when you need to change that unit, you got to get a crane. I was like,
exactly.
I'm like, a crane? And then, so as things started falling apart, I started factoring like the crane's gonna cost this is gonna cost that. And I had a maintenance agreement on all of it. I bought it from the owner who had it for like 20 years. It wasn't even an old property. And as soon as I used that equipment warranty, they canceled it.
Mm,
And as soon as I used, and they said, yes, in the fine print, it says we can cancel. So even if you buy it and you get that equipment warranty on it, know that they will fold. What's that, James River? Every time I see one of their commercials, I go, oh my goodness, I'm still mad at them. Like, how are you going to cancel the warranty? And I was paying like it was thousands a year for the warranty.
wow.
And they said, but you can still do maintenance with us. That was really bad. So yeah, so you're looking at somebody mentioned commercial, you think residential is expensive. Commercial's on a whole nother level.
Yeah.
What were you gonna say, Mr. Anderson?
You got to know or have somebody to go with you to look at a property to know that the area that it's in is coming up, not going down. You don't want to
Right.
buy a property in an area that's going down. You want to be able to look at the house and know what's wrong with it. I mean, I can go into a house and look at the plumbing and electrical and know how much and have a good idea how much is it going to cost me to renovate this place. I mean, I've looked at houses that I'm like, oh no, this is going to cost me too much to fix this up. There's too many things wrong with it. You got to know that you don't want to buy something that's going to make you go broke trying to fix it up. If you buying a house that you want to renovate, fix it up, even if you want to rent it out, you want to know that how much is it going to cost you to fix this property up. So you want somebody, if you don't know how to do it, you need somebody to go with you into the place and look at it and be able to assess how much is it going to cost me to fix this place up.
And so many people do properties with people that you know and love, and you go in here and we go, we're going to get this together. But you can know and love someone, but they can really have some bad business ethics. So when you know that person doesn't have as much money as you going in, they better have some skills that you don't have. And then you have to like quantify what their skill is, because you definitely need to, I see it way too often. You lose friendships behind this. You're putting in all the money, and then they say what they're going to do. And then if they don't do what they said they're going to do, so no matter how close they are, how many cousins deep y'all are, get everything in writing when it comes to this, because a lot of partnerships are used in real estate. That's not easy. I've made a commitment that if I can't do it by myself, that I'm not going to do it. But a lot of things, you can get a lot more accomplished if you can do it together. But you have to be, really careful about who you get. Like sometimes I go, well, I could have, probably accomplished more, if I had more investors in my business, or if you buy more properties, if you have more people involved, but then you have more people you have to get involved in it.
Yep.
So both of these people are saying they did these things on their own with their family, and that's important to make sure that you realize that. So some key things that we have mentioned tonight was, one, like generating income. And you really don't know how much income you have made unless you know what the expenses are involved. And then also, I'm gonna make sure that we need to have an understanding of depreciation. And a lot of people buy properties for investment. Now, depreciation cannot be used on your house. This isn't a depreciation expense. It's how you expense off the declining value of the property that you purchased that you're using for rental. It is one of the biggest benefits of real estate investing because it reduces the income that you have to report on that property on your taxes. But there are so many people that have property and they don't depreciate it off. So we need to write that down and make sure whoever is helping you own real estate, whoever is helping you, get a better understanding of the depreciation and how they're reporting it. It's over the life. So basically on a property, you can depreciate it off for over almost 30 years. But when you sell it, what happens to that depreciation, Mr. Anderson?
You pay it back, right?
It's all added back. All added back. And that's what, that a lot of times people, so this tax preparer said to me, she said, well, what you have to do is tell your clients, if they want to avoid capital gain, don't sell the house for so much. I said, don't you ever repeat that out loud, ever, for the rest of your everlasting life. Don't you ever tell anybody not to sell their property for a lot. Why would you buy? You better maximize that sale price and you better minimize your purchase price. You want to have the gain. There are other ways for us to control the capital gain. Believe me, you need to, but we have to really get an understanding of depreciation and be very careful who you get your advice from.
I had a tax preparer tell me that, sell it for less.
Stop! Another one. That was a tax preparer that told me that.
Yeah.
That is, well, what we need to realize is that a financial planner is different than a tax preparer. But when we go to the tax preparer, we really do think that they have an understanding and they don't have any idea. You have to actually ask for someone that is very successful in real estate, if they were really, going to someone to get, strategies, but you wouldn't be at tax prep time because you already will have done everything wrong, so because all they're doing is taking the value of the property and then they're doing it for them, right? They don't even probably know what depreciation is based on. This, the value, and they just fill in the blanks, divided by 27 and a half years. That's how much you get. You're in year 6, you know what I mean? Every year, blah, blah, blah. Then they add it all back when you sell it, so you might feel actually they take it all back from you when you sell it. So your capital gain is larger. So you might have, feel oh, I only made, this much. But then they go, no, you wrote off all of this. So on your depreciation, so no, you got to give us that back, so it makes your gain look larger because it's pulled away from your cost basis. Well, but hopefully, because I'm speaking really quickly, but just know that depreciation will be factored in your sale, and it does increase your capital gain because you've been enjoying that tax benefit for the entire time of having the property. And this is there a cutoff age for capital gain tax? Yeah, like death. That's about it. Good question though. No, they gonna get you. And I think like someone else will pay it after you die. But yeah, the good question. No cutoff age. Property taxes sometimes, but not on that game. It says if you have rental properties, what are the pros and cons of engaging in a property manager and engaging a property management company? We talked about that. You know, we're saying that it's the only con is that the expense of it. If they're charging you $200 a month, you know, that's over $2,000 a year. So it's an expense, but it's taken away from your income, you know, what you're making on property. So we shouldn't get really excited about losing money all the time on real estate. Like if you're generating a loss because of depreciation, that's cool. But if you're generating a loss because of and then you can't even, in your passive loss, like it's real tricky because you can't even really write off, you know what I mean, all of your passive loss. It has to be against your passive income. So it's not, you have to be really get a good understanding of factoring in these expenses and understanding them, but it's not okay to have a property that you're not clearing what you owe on it. And I guess that's the bottom line. I want to say, like, you're paying $1,000 mortgage and your rent, your income is $800. You know, that's a problem, right?
Right.
It's not okay. And then sometimes, you know, I have had clients who have had years that their tenant did not pay. And I've had to force the client to get that person out of that property. That is ridiculous. And one thing, the difference between a commercial property and a residential property is commercial can lock you out in 30 days. But residential has to go through all that process. You know what I mean? Commercial lock you out, take everything in there, whole nother level. You don't have to worry about that with commercial property, all of that trying to satisfy codes and all of this stuff with it. You can't, but you're not, your business, if you better pay your rent, you know, for the business, then the business better pay you. But on residential, you can't just put people out. You got to serve them. You got to go to court. You got to go through all these different things. And think about right now, how many property owners cannot evict people?
Yep.
That's amazing. Someone asked a question about, there is software also, there's software that will assist with reporting this on your taxes. When you do, say you use TurboTax, they will ask you every question that you need, but you have to know all of the answers. They'll calculate the depreciation for you. That's the same thing that the tax preparer does. You just have to take the time to put it in. Yeah, I think a lot of times we just don't take the time. And I've made a commitment to doing things like this with the client. They share their screen with me. I look at their tax return. We can go through the things together. That helps. But some of you, and I think it's cool, don't want to do it. And if you don't want to be messing with that, if you're not going to give it the time, don't do it. I don't like to do my own hair. You know what I'm saying? I like to do my own nails unapologetically. So you don't want to do your own tax return. You have to sit down there like you, Bryan. I love doing that kind of stuff. So don't do what you do. If you're not going to do it and really commit to it, I'll spend the whole day doing my tax returns. I love doing my business ones too, but that's just what I like to do. And it says there will be lots of foreclosures in the future due to the current economic situations. Indeed. 1995, you should put your name in there. You have a lot to say. You put the year I established my business in there. I love it. That's where that passcode comes from. But you all are great. I want to also, before we go, the key things I want to point out, passive losses, get an understand of that. That's your losses on real estate property. You know, losing money on an investment is a bad thing, but in the case of real estate property, it could have tax benefits. So if you're going through losses, I want to see why you're getting them. All right? That's what we're going to look at. And then make sure that you get an understanding of a 1031 exchange. You heard Mr. Anderson say that he took a property, then he buy another property, then you buy another property. A 1031 exchange allows an owner to sell a property, use the money to buy a new property, and defer the capital gains taxes. But then when you get to retirement, then we have that challenge of, planning for the capital gains, planning for that last sale of enjoying, because you want to enjoy what your investment at that point. And then a big mistake that many property owners make is not properly depreciating their property. And it can be a big mistake because often the IRS assumes that you've taken the depreciation. So when you sell it, you may pay taxes on that depreciation recapture that I was talking about, and it could be on what you never actually benefited from. So be careful of making sure that you do the depreciation on your investment properties. And then those are, I think, the key points I wanted to make sure. Let's make sure they have any. Hi. Sheila Jefferson wasn't able to attend tonight, but well, you tell her, Maurice, that I want her here next week. Thank you to our special guests. Y'all were the best. Anybody have any more questions? No, that was about real estate. I think we should do this again. You think so, Ms. Hayes? I mean, it's amazing how many years that I have thought, there's so much stuff that we can give people that they're going out there paying for that I want to give it to you for free. And knowledge is power.
Yep.
The good book says our people shall perish due to lack of knowledge. It won't be for lack of me trying to give it to you. So I want to give you a great guest and subject. That's what Twyla said. And if Twyla says it, it's true. Great guest. And some good applied knowledge. That's right, Ms. Cotman. You all have a wonderful week. Members only meeting is Friday morning, and it's about taking care of yourself. We have a fitness expert, Suyapa, is going to be there, and also Fonda Neal is going to be there talking about the 7 components of taking care of yourself. She's a nutrition coach. So it's going to be about self-care. Is that the new word? Self-care? I'm gonna try to, but that I will send that out soon as possible. I appreciate you all so much. Thank you. And I will hang around. I'm gonna let my guests so that they don't have to, I'm gonna let y'all off, and I will hang around just so if you have some additional questions. Like when I go to this, and then I will do this, and then Ms. Hayes, you will be free to be you. And then I let Mr. Anderson go. Thank you so much,
Thanks.
Mr. Anderson. You are the best. All right. Y'all are the best. Our guests were the greatest. Y'all have a wonderful night.